Thanks for joining David, Kevin, and myself for the market update for the month of December. I hope you guys all had a fantastic Christmas and New Year's. I know we sure did. It was just great. I am super excited about 2023. And David and Kevin are going to give you a recap of what happened in December and the last quarter. But as always, if you ever have questions, please don't hesitate to give David, Kevin, or myself a call. We look forward to working with all of you again in 2023. Take care.
David, how did investment markets perform in December?
Well, equity markets globally took a bit of a step back in December, Kevin, after a strong November. In the United States, the S&P 500 was down 4.6% in the month of December. In Canada, the S&P TSX was down 4.9%. And elsewhere globally, the MSCI EAFE index, which is Europe and Asia, was down 0.97%. So North America was a bit of a weak spot in December globally compared to the rest of the world. Kev, what was driving that?
Statistics Canada released their CPI report showing that inflation had slowed to 6.8% in November, and this was helped by lower gasoline and furniture prices. However, those declines were offset by grocery prices, which are continuing to climb. Even though inflation did slow, it wasn't by near as much as most of us had hoped. Turning the temperature down on inflation has proven to be a much slower process than anticipated. This persistence led to the Bank of Canada and the Fed in the US to raise their interest rates by 50 basis points each in December. The Bank of Canada did signal that it was open to pressing the pause button on future rate increases depending on how the economy continues to evolve. They will be reviewing end of year 2022 data before their January 25th next rate announcement.
Looking ahead to 2023, we are starting to see economic leading indicators such as consumer confidence and global manufacturing output numbers start to come in, which are indicators typically that corporate earnings may fall a bit heading into 2023. Now, the logical investor may say, hey, well, if corporate earnings are likely to decrease in 2023, the stock market must be due for another leg down from 2022. And so, maybe I should sell my stocks. And while that may be the logical conclusion to draw, historically it's typically not been the case. Going back to 1963, when we look at the U.S. stock market, the S&P 500, if we look at 12-month periods in which earnings actually did fall, the stock market was positive 2/3, nearly 66% of the time, with an average gain of 7%, no less.
And this is a good reminder that the stock market is a forward-looking. That even when you look out and look at the economy in real time right now with what's happening, a lot of times the stock market has priced this in. This forward look was showcased during the 2008 Great Recession. In that recession, which was deemed over May 31st, 2009, by the time that day came, the stock market had already risen 14%. And this is a really good example of why the buy and hold strategy has been so effective over long periods of time. If an investor had withdrawn their money during that recession and held on to it, waiting for the economy to recover before redeploying that cash, they would have missed out on roughly 14% worth of growth.
Mm-hmm. And that's a great point to remember right now at this juncture, Kevin, in early 2023. I know Harry, Kevin, and myself have been receiving some questions from clients in recent months. Obviously, 2022 was a very difficult year for investors with broad equity markets being down pretty significantly and even bonds. And so investors are asking, well, should I just sell and exit stage right and go sit in cash, which is finally yielding an attractive interest rate at like 4% right now for cash. And while it may be compelling to do that, and it may even seem logical in this environment where, probably the average household starting to feel the pinch from these higher interest rates, which, by the way, that's exactly what the central banks are hoping for to try and get inflation under control. So logically, everyone's sitting around saying, okay, well, if the economy is softening, surely I would be better off just staying in cash. And while that may seem logical, history has proven that that's oftentimes the wrong thing to do. and that you'd be better off just buying and holding and waiting for that stock market recovery to happen, because it always does. And sometimes, and oftentimes, it actually happens while we're still in the midst of a recession. The stock market, like Kev said, is forward looking. And so just keep that in mind as we head into 2023. And as always, if you have any questions about your portfolio or the markets in general, and you'd like to speak with Kevin, Harry, or myself, we of course would welcome your call. Take care.